Parag Parikh Flexicap is one of the most popular mutual fund in India with an AUM of 1.33 lakh crore rupees. Now this fund has a great reputation of consistent performance and disciplined strategy, and it has often outperformed the benchmark and category peers in the past. However, in last 1 year, this fund has been underperforming both benchmark and category average return. To be precise, in last 1 year, this fund has generated 8.3% return versus benchmark return of 14% and category average of 13.5%. As of today, in last 1 year, Parag Parikh Flexicap Fund is ranked 33 out of 39 funds. That's where in this video, we'll discuss why Parag Parikh Flexicap Fund is underperforming in last 1 year. More importantly, what should you do as an investor? Continue your SIP or switch? This also raises a very important question. How do you really shortlist a right mutual fund for SIP? Alright, let's get started. So first, let's take the obvious question. Why is Parag Parikh Flexicap underperforming in last 1 year? To understand this, we need to step back and look at their investment style. So this fund house has always followed a very valuation conscious, business quality driven approach. They are not momentum chasers. They don't rotate aggressively into whatever sector is leading the market at that moment. And they are comfortable holding cash when they don't find an adequate margin of safety in the market. Now, if you look at Flexicap category in India, it is benchmarked against Nifty 500. Within Nifty 500, large cap, that is top 100 companies, have around 75% weightage, and remaining 25% weightage is from mid and small cap. And if you look at Parag Parikh Flexicap latest breakup, it has less than 80% money invested in equity. Almost 19-20% is in cash. So on one side, while Nifty 500, that is benchmark, is 100% equity, Parag Parikh is not exactly mirroring it. It is sitting on significant cash. In fact, a few months ago, it was sitting on as high as 25% cash. Mr. Rajiv Thakkar clearly called out that the reason for sitting on cash was purely due to lack of valuation comfort beyond a certain sector. So obviously, when the fund house sits on cash, the returns from cash components are very low. Now, this strategy of holding cash works well when the valuations are stressed and market is going through a difficult phase. And that has been the case with Indian market for quite some time now. However, this strategy can backfire if the markets outperform. Now, this is quite debatable on whether Parag Parikh Flexicap should sit on so much of cash component or not. But recently, they have reduced the cash component and allocated money in equity. Second, if you look at equity breakup, Parag Parikh Flexicap is almost completely invested in large cap as they did not find valuation comfort in mid and small cap. Whereas Nifty 500 has 25% allocation in mid and small cap. Again, this strategy has worked well for Parag Parikh as mid and small cap has significantly underperformed in last 15-16 months. However, if you look at exact point in time 1 year return, Nifty mid cap 150 has generated 20% return and Nifty small cap 250 has generated 13% return. If you recall, last year January-February period witnessed brutal correction in mid and small cap, and then there was a sharp recovery. So basically in last 1 year as of 18 February, Nifty 500 performed relatively better because 25% weightage was from mid and small cap. Then third reason for underperformance is due to some global exposure. Parag Parikh has exposure in US companies like Alphabet, Meta, Amazon, Microsoft. And except for Alphabet, remaining stocks have underperformed in last 1 year. However, the most important thing you should understand is this point in time return of last 1 year is a completely wrong metric to gauge performance of a mutual fund. The right metric to gauge mutual fund performance is based on rolling return. In case you don't understand what is rolling return, please Google it. So if you look at Parag Parikh performance versus benchmark, it has consistently beaten Nifty 500 across 1 year, 3 year and 5 year rolling return basis with a huge margin. Not only that, it has also beaten the category average across 1 year, 3 year and 5 year rolling return basis. And if you look at ranking based on rolling return, Parag Parikh stood at 9th position in 1 year rolling return period, 7th in 3 year rolling return basis and 2nd on 5 year rolling return basis. So first of all, the entire thesis of calculating rank based on point in time return of last 1 year shows completely flawed return. Parag Parikh Flexicap has actually outperformed on rolling return basis. Now, return is one aspect of checking fund performance. What about the risk? Ideally, the fund should not only generate high return, it should also be less volatile during difficult times. So you should also check how much the fund has performed during the market correction phase. And that's where you can look at KPI called beta. Beta is a measure of sensitivity of a fund's return related to its benchmark. So for instance, if beta is 1, it means fund is moving roughly in line with the benchmark. If beta is more than 1, the fund will jump more than the benchmark in good markets but will also fall during the correction phase. If beta is less than 1, the fund may lag in big rallies but also fall less when market is correcting. And Parag Parikh has low beta versus category average in last 3 years. It shows fund has very low volatility. Now if you want to compare both risk and return, or in other words, risk adjusted return, which in my opinion is the most important thing to check, so you can look at Sharpe ratio. Basically, high Sharpe ratio means better risk adjusted return. Lower Sharpe ratio means you are not being compensated enough for the volatility you have taken. And Parag Parikh Flexicap has excellent Sharpe ratio as compared to category average. It simply suggests Parag Parikh Flexicap is taking lower risk, keeping cash, avoiding overheated sector, yet able to generate benchmark and category beating returns. So I hope you got some clarity in terms of Parag Parikh performance. Please don't get carried away with underperformance narrative based on last 1 year of point in time return. Always look at rolling return and check the Sharpe ratio. Also, please note that when you invest in equity mutual fund, you want to achieve your financial goals that may be 5 year, 10 year, 15 or 20 years down the line. Now in this period, you will come across phases where your fund may underperform. And if you exit every time that happens, you will never experience the full benefit of disciplined compounding. And that's where you need to build confidence before investing. And to build confidence, you should definitely look at past rolling return, but at the same time, you need to look at the investment style of that fund manager or the fund house itself. So basically, you need to understand whether that fund house or fund manager style align with your thought process or not. So Parag Parikh Flexicap is a value-oriented fund. It does not chase momentum. It does not churn its portfolio massively. In fact, Parag Parikh is one of the only few funds who does not participate in IPOs because they have a very clear philosophy set by late Mr. Parag Parikh, and that philosophy, or rather legacy, is now carried forward by Mr. Rajiv Thakkar. I have utmost respect for him and the fund house. They follow boring value investing approach and they don't change their style at all. And that for me is very important. In fact, you can see that this fund has a low PE multiple of 20 versus category PE of 25. Price to book is also low, dividend yield is much higher, and even the sales growth is higher than category average. Isn't that interesting? On one side, sales growth is higher than category. On another side, its PE is much lower. Here there is just one caveat that I want to highlight. See, Parag Parikh Flexicap Fund now manages an AUM of 1.33 lakh crore. That is massive. With that size, it becomes difficult to meaningfully deploy money in small and mid cap without impacting the liquidity. So naturally, the fund tilts more towards large cap. Again, that's not a flaw, but something that you should be aware of. So if you're looking for a fund that provides higher exposure in mid and small cap, and if you're comfortable with sharp ups and downs, Parag Parikh Flexicap may not be the ideal fund for you. This fund is designed more for steady compounding with downside protection. So yeah, that's it from my side. Do not want to stress this video further. Now tell me in the comment which is your favorite preferred mutual fund. And do share this video with those who have invested in Parag Parikh Flexicap and confused what to do. I'll see you next video. Till then, take care.